All right, let's truly unpack this. For what feels like an eternity in the crypto world, Bitcoin has reigned supreme. The undisputed king, the first name that springs to mind when you even whisper digital assets. It pioneered the path, solidified its role as digital gold, captured the collective imagination like nothing else really. But what if, right now, the very foundations of that long-held supremacy are being quietly, yet powerfully reevaluated? What if a titan of traditional finance, one of the biggest investment banks on the planet, JPMorgan, is observing a profound structural shift in this hierarchy? You might find it genuinely surprising, maybe even a little unsettling, to learn that their most recent analysis points to incredibly compelling reasons why Ethereum isn't just holding its own, but is, in fact, outperforming Bitcoin right now. Why is this happening? What are the underlying forces driving this remarkable shift? And what are the deeper implications for the future of decentralized finance and, well, the entire evolving crypto landscape?
What's truly fascinating here, and I think crucial for anyone watching this space, is that we're not simply talking about, ephemeral short-term speculative gains fueled by fleeting market hype. JP Morgan's analysis, and this is where it gets really interesting for me, it drills down into four concrete fundamental drivers. These aren't minor fluctuations. They hint at a more structural, maybe even more permanent shift, both in investor sentiment and, more importantly, institutional adoption. This isn't just about daily price movements. It's about the underlying utility, the network effects, the market mechanics. They're defining a new chapter. It raises an essential question for all of us, doesn't it? Is Ethereum truly carving out a new, potentially more dominant path for itself? Or are these merely temporary market dynamics, kind of a cyclical rotation that will eventually see the market revert to familiar patterns of the past? The distinction is absolutely crucial for understanding where the smart money is genuinely moving and why.
That's exactly what our mission is today. We're taking a deep dive into this topic, trying to cut through the noise and the often complex financial jargon. We've gathered some incredibly insightful material for this deep dive, primarily drawing from JP Morgan's groundbreaking analysis. Their findings have been robustly echoed and explored in significant detail by other reputable sources like CoinDesk, The Block, and Root Data. These collective articles, they all converge on and explore this intriguing and increasingly pertinent idea of Ethereum's recent sustained strength relative to Bitcoin. Our goal for you, our listener, is to distill this information, to highlight the most important nuggets of knowledge so you can grasp not just that Ethereum might be pulling ahead, but the tangible foundational reasons why. We're talking about understanding the mechanics, right? Not just chasing a trend.
Indeed. And we'll be meticulously looking at everything. From the massive inflows we've seen into newly launched exchange-traded funds, ETF, to the potential and, frankly, highly anticipated regulatory shifts that could fundamentally redefine how traditional finance interacts with digital assets. We'll also examine the increasingly significant trend of corporate balance sheet adoption. That's a move that speaks volumes about long-term conviction. And even innovative new ETF structures designed to enhance market efficiency and stability. The overarching goal here is to provide you with a truly comprehensive understanding, connecting all these seemingly disparate dots, so you can grasp not just what is happening in the crypto market right now, but why it truly matters. In the broader context of digital assets, the evolving Web3 economy, and, well, your own investment perspective. This isn't just about tracking prices, it's about discerning the foundational tectonic shifts underway.
Okay, so JP Morgan, a name synonymous with global finance, they've meticulously pinpointed four key factors. Factors they believe are fueling Ethereum's recent surge and its demonstrable outperformance relative to Bitcoin. Let's not waste any time. Let's jump straight into the first one, which for many is an absolutely eye-opening revelation and perhaps the most direct, undeniable indicator of shifting capital. Massive spot ETH ETF inflows. JP Morgan's report highlights an astonishing figure. July alone saw an astounding $5.4 billion in spot Ethereum ETF inflows. Now, to truly appreciate the magnitude of that number, let's put it into some historical perspective. That figure, $5.4 billion, it actually matches almost dollar for dollar the level of inflows Bitcoin ETFs experienced at their peak, during their own initial launch excitement. For years, the narrative has been squarely focused on Bitcoin, celebrating its ability to attract the lion's share of institutional interest, the capital through its ETFs, solidifying its position as the go-to institutional crypto. But here we see Ethereum not just competing, not just making strong showing. It's unequivocally equaling that initial powerful momentum. But here's the crucial difference, and this is where the story gets really, truly interesting. While Bitcoin ETFs have, since that initial peak, experienced modest outflows, maybe indicating some profit-taking or a reevaluation of allocation by early movers, Ethereum ETFs have continued and are still continuing to attract significant capital consistently. This isn't just a fleeting number, it's a powerful and persistent signal. A signal of a palpable shift in investor sentiment, a clear sign that confidence in Ethereum is not only growing, but it's proving to be far more sticky and committed than many initially anticipated. To visualize this, imagine the flow of global investment capital as a mighty river system. For years, the Bitcoin river was the dominant surging force, drawing all the attention and resources, its current undeniable. But now, we are witnessing the formation of a truly significant tributary for Ethereum, with its own powerful and sustained current that, unlike Bitcoin's, hasn't just subsided after the initial rush. It's not just a splash, it's a developing self-sustaining flow. This implies a deeper, more committed allocation from institutional players. Not just a speculative foray or a brief tactical trade. It suggests a growing number of funds and institutions are betting on Ethereum's long-term utility and ecosystem growth.
This is a critical observation. And if we connect this to the bigger picture, this sustained and robust inflow into ETH ETFs suggests a growing confidence that extends far beyond early retail adopters and individual speculators. Institutional money, as you know, is notoriously cautious. It operates under stringent regulations, and it tends to move with deliberate, measured pace. So for these large, sophisticated players to continuously direct substantial capital into ETH ETFs, especially at a time when BTC ETFs are experiencing modest outflows, well, that could very well indicate a much more mature and nuanced investment thesis for Ethereum. It implies that these larger players are looking at Ethereum not just as another speculative digital token, but as a foundational technology, a programmable platform with clear utility, a vast ecosystem, and a promising future roadmap. They are essentially buying into the ecosystem, the platform, and its potential for generating economic activity and innovation, signaling a more fundamental conviction. It suggests these aren't just temporary market dynamics. It's a reevaluation of which asset is better positioned for future growth and innovation.
That distinction between temporary and fundamental, that's key. And a compelling analysis naturally leads us to the second driver JPMorgan highlights, one that truly has the potential to be a real game changer, fundamentally altering Ethereum's investment proposition. Expected SEC approval of staking for ETH ETFs. Okay, the core information here is that traders and market participants are widely anticipating, with a high degree of confidence, that the U.S. Securities and Exchange Commission, the SEC, will eventually allow ETH ETFs to offer staking yields directly to their investors. Now, let's break down why this is such a profound potential game changer for Ethereum. Currently, if you, as an individual, want to stake Ethereum directly on the network, meaning you participate in validating transactions and securing the network in exchange for rewards, it typically requires locking up a full 32 ETH. Depending on the current market price of Ethereum, this can represent a substantial capital commitment for most individual investors, often tens of thousands of dollars. Beyond the capital, it also involves a certain level of technical know-how, either running your own validator node or navigating various liquid staking providers, each with their own set of risks and complexities. But if these ETH ETFs can offer staking yields without requiring that massive capital commitment or demanding technical expertise from investors, it dramatically alters the investment landscape. Suddenly, gaining ETH exposure becomes potentially much more profitable and significantly more accessible than simply holding Bitcoin. Why? Because Bitcoin, by its very design as a proof-of-work chain, doesn't offer native staking rewards. Its value proposition is fundamentally different, right? Centered on scarcity and a store of value. Here's where, for me, it truly gets transformative. If you can get a regular, attractive yield on your ETH through an easily accessible ETF, it's no longer just a store of value or solely a speculation play on price appreciation. It intrinsically transforms into an income-generating asset. That fundamentally changes everything, doesn't it? It expands Ethereum's appeal to an entirely new class of investors, those who are actively looking for yield and income streams in their portfolios, a staple offering that traditional finance has always provided.
Precisely. To truly grasp the magnitude of this, consider the typical investor who traditionally seeks yield in established markets. They might be looking at a diverse range of assets like corporate bonds, dividend-paying stocks, or real estate investment trusts. These investors are often characterized by their conservatism, prioritizing consistent returns and income generation over purely speculative, high-growth plays. If they can now gain exposure to crypto, specifically Ethereum, with an attractive, verifiable yield, all wrapped within an easily accessible and regulated ETF structure, it dramatically alters their risk-reward calculation for digital assets. This isn't just a marginal improvement, it represents a fundamental bridging of a significant gap between traditional finance and the decentralized world. It makes Ethereum a compelling, viable proposition for income-focused portfolios. Portfolios that previously would have entirely steered clear of the perceived volatility and lack of income generation in crypto. This definitively moves Ethereum into a hybrid category that Bitcoin, in its current architectural form, simply cannot occupy.
That's a huge point about bridging traditional and decentralized finance. But here's a thought that sometimes crosses my mind, playing devil's advocate for a moment. Bitcoin's pure scarcity, its very lack of yield, is often lauded as its core strength. That it offers a different, perhaps purer value proposition that yield-seeking assets can't replicate. Are we, by pushing for staking yields, trying to make Ethereum something it isn't, just to fit a traditional finance mold, potentially compromising its unique attributes?
That's a very insightful question and a perfectly valid perspective. It speaks to the fundamental philosophical difference between the two assets. Bitcoin's strength, as you rightly point out, lies in its hard cap supply and its role as a decentralized, immutable store of value, often likened to digital gold. Its value is largely derived from its scarcity and censorship resistance, not its utility as a platform or its ability to generate income. Ethereum, on the other hand, was always conceived as a programmable blockchain, a global computer. Its value derives from its utility, its network effects, and its ability to power an entire ecosystem of decentralized applications and financial services. Staking is integral to its proof-of-stake consensus mechanism, which offers security and validates transactions. So integrating staking into ETFs isn't forcing Ethereum into a mold it doesn't fit. It's simply leveraging an inherent feature of its design. It's about making Ethereum's existing utility accessible to a broader audience, thereby expanding its addressable market. Without compromising its core identity as a programmable platform, it's an evolution of access, not a fundamental change in its nature.
That makes a lot of sense, framing it as an evolution of access. Now, for the third key factor JPMorgan highlights, shifting our focus from individual investors and institutional funds to something even more weighty: corporate treasury adoption of ETH. This isn't just individuals buying, this is significant corporations placing Ethereum directly onto their balance sheets. We're observing a significant and growing trend here that speaks volumes about institutional belief. Around 10 publicly traded companies are now holding Ethereum directly on their balance sheets. These aren't just obscure startups or private ventures. These are public companies operating under intense scrutiny, with strict fiduciary responsibilities to their shareholders. To give you a concrete sense of the scale and significance, these collective corporate holdings represent approximately 2.3% of the current ETH circulating supply. That's a non-trivial amount of Ethereum being actively pulled out of the open market and held as a strategic asset by established, regulated entities. But these firms aren't just passively holding Ethereum hoping for price appreciation. JPMorgan's analysis suggests they may also be strategically looking to earn additional yield by staking their ETH or actively participating in decentralized finance or DeFi protocols, which refers to blockchain-based financial applications. This demonstrates a sophisticated approach to treasury management, akin to how they might manage other traditional treasury assets like short-term government bonds or commercial paper, seeking to optimize returns on their reserves. It speaks to a deep-seated belief in Ethereum's multifaceted utility that extends far beyond mere speculative price movements. Imagine a hypothetical software giant, deeply invested in Web3, holding ETH not just for its price, but for direct use in their dApp ecosystem, or a major financial firm using it for internal tokenization projects and cross-border settlement experiments.
This trend raises an incredibly important question, particularly for those familiar with corporate finance. Why would public companies, with their inherent conservatism, strict governance, and unwavering fiduciary duties to shareholders, why would they intentionally take on this kind of exposure to a relatively new and still volatile asset class? It strongly suggests a perceived long-term value and utility for Ethereum that goes well beyond purely speculative reasons. These companies aren't simply buying it to hold and hope the price goes up. They are actively exploring how to integrate it into their broader financial strategies, leveraging its programmability and the vast ecosystem it underpins. This signals a deeper conviction in Ethereum's role as a fundamental piece of digital infrastructure, not just another digital asset. They're looking at the platform, the smart contract capabilities, and the potential for yield. Understanding that it offers more than just being a store of value, it's an operational asset.
I understand the allure of utility and yield for these corporations, but let's press on this for a moment. What about the risks? Public companies are usually risk-averse. What are the biggest risks they're balancing when they decide to put Ethereum on their balance sheets? Especially given crypto's historical volatility, are they truly prepared for potential swings, or are they perhaps underestimating the unique challenges?
That's a critical dimension to consider, yes. While the potential for yield and utility is attractive, corporate treasurers are acutely aware of volatility risk. They're likely employing sophisticated risk management strategies, perhaps hedging some of their exposure, or maybe only allocating a small percentage of their total treasury. The risks include not only price volatility, but also regulatory uncertainty, which, as we'll discuss next, is slowly improving. There's also operational risk, like secure custody of these digital assets and smart contract risk if they're engaging in DeFi. However, the fact that they are making these allocations despite these risks, it suggests a calculation that the perceived long-term strategic benefits, like being at the forefront of Web3 innovation, gaining early access to new financial rails, or simply diversifying a treasury beyond traditional assets, that these benefits outweigh these challenges, especially if they believe regulatory clarity will continue to improve. They are betting on the long-term value of Ethereum as a foundational layer, even with short-term bumps.
That's a good point about the calculated risk. And that brings us perfectly to the fourth driver, which truly underpins a lot of this growing institutional comfort and confidence. Regulatory clarity and ETF structure innovations. This is about making the environment not just safer, but also demonstrably more efficient for large-scale institutional money to flow in. The core information here is actually twofold, each equally significant. First, we're observing increasingly clear signals emanating from SEC staff. Signals that suggest liquid staking tokens might not be classified as securities. Let's quickly define that. Liquid staking tokens are essentially digital receipts you receive when you stake your ETH through a service. While your actual ETH is locked up, these liquid tokens allow you to use your staked ETH, for example, as collateral in other DeFi protocols, providing liquidity and utility even while it's earning staking rewards. This potential non-classification is a monumental development. Monumental. Because it significantly eases institutional apprehensions. A major persistent hurdle for large regulated entities entering the crypto space has always been the immense shadow of regulatory uncertainty and the very real fear of inadvertently violating complex securities laws. If this classification becomes official, it provides much-needed green light, fundamentally reducing the legal and operational risks for funds and corporations engaging with staking-related products and, by extension, Ethereum itself. Secondly, there's been the crucial approval of innovative ETF structures, specifically the go-ahead for in-kind redemptions for ETH ETFs. This isn't just a dry technical detail buried in financial filings. It's profound structural innovation with real-world impact. To illustrate what in-kind redemptions truly mean, imagine you own shares of an ETH ETF and you decide you want to redeem them. With traditional cash redemptions, the ETF provider would have to sell some of its underlying Ethereum holdings on the open market, convert that crypto into cash, and then give you the cash. This can create selling pressure, especially during periods of high redemptions, potentially driving down the price of Ethereum. But with in-kind redemptions, the ETF can simply give you the equivalent amount of actual Ethereum directly, bypassing the need for an open market sale.
It's like exchanging a concert ticket for the actual experience. Rather than having the venue sell your seat, then give you the money from that sale, this direct exchange removes a layer of friction. So if the SEC is consistently giving clearer signals like these, it's akin to a broad green light for much bigger players to jump in with far greater confidence. And these in-kind redemptions, that's a bit technical as we've explored, but what does it really mean for someone holding an ETH ETF? Why is that such a big deal? And how does it specifically enhance the market's stability and efficiency?
Oh, it's absolutely a big deal, and it really addresses a core vulnerability of ETF structures. Essentially, in-kind redemptions remove a significant layer of friction and, crucially, potential market volatility that exists with traditional cash redemption ETFs. Imagine a scenario where the market is already experiencing a downturn and a large number of investors suddenly decide to redeem their ETF shares. With cash redemptions, the ETF would be forced to sell billions in crypto into an already falling market just to generate the cash to give back to those investors. That forced selling can exacerbate price declines, creating a downward spiral and adding significant unnecessary pressure on the underlying asset's price. With in-kind redemptions, however, when an investor wants to redeem their ETF shares, the ETF can simply hand over the equivalent amount of actual crypto directly to them instead of selling it for cash. This makes the process dramatically smoother, significantly lowers operational costs for the ETF providers because they avoid brokerage fees and market impact costs. And crucially, it drastically reduces the potential for those forced sell-offs during periods of high redemptions. This innovation stabilizes market prices, improves liquidity for the ETF, and ultimately signals a more mature, robust, and resilient market structure taking shape for Ethereum. It's about designing a financial product that is inherently less prone to contributing to market instability and, in turn, makes the entire ecosystem more trustworthy for institutional capital.
So these in-kind redemptions, while they sound technical, clearly bring substantial benefits in terms of market stability. But, again, playing devil's advocate, could this make these ETFs seem too safe? Potentially drawing in unsophisticated investors who might not fully grasp the underlying volatility of Ethereum itself, leading to unintended consequences down the line.
That's a valid concern about investor education, absolutely. While in-kind redemptions enhance market mechanics and reduce a specific type of systemic risk, they don't eliminate the inherent volatility of the underlying asset, Ethereum. The role of the ETF issuer, and indeed financial advisors, becomes even more critical in clearly communicating that while the structure of the ETF is more robust, the asset it holds still carries significant risk. It's akin to investing in a highly liquid stock ETF. The ETF structure is efficient, but the underlying stocks can still fluctuate wildly. So while these innovations are a net positive for market efficiency and institutional comfort, the responsibility to understand the underlying asset's risk profile ultimately still rests with the individual investor. It points to an ongoing need for financial literacy in this rapidly evolving space.
That's an important caveat, yes. Now, let's unpack this further. We've discussed these 4 drivers from JPMorgan, but let's look at some real-world examples in historical context that gives even more weight to these insights. It's one thing to talk about drivers in isolation. It's another to see their tangible impact woven into the broader market narrative. We've touched on it, but let's elaborate on the sheer, undeniable momentum of these ETF inflows. We're talking about sustained Ethereum fund inflows directly contrasting against persistent Bitcoin outflows. This isn't just a temporary blip on the radar, a one-off anomaly. It highlights a tangible, observable, and I would argue increasingly profound shift in investor sentiment. It demonstrates a growing, perhaps even deepening, trust in Ethereum's ecosystem and its long-term future potential. What does it truly signal when capital, especially institutional capital, starts to consistently flow out of the established leader, the digital gold that Bitcoin has represented for so long, and into the challenger, Ethereum? It suggests a fundamental reevaluation of value propositions and perceived growth trajectories.
Investors are actively looking beyond just a store of value and increasingly recognizing the potential for a dynamic, evolving, and programmable platform. It's a reassessment of where the future innovation, the future utility, and therefore the future value in the crypto space will truly lie.
This reevaluation is absolutely critical, and it signals a maturation of the market's understanding of digital assets. It implies that a significant growing portion of the market is shifting its primary focus, moving from solely speculative growth to fundamental utility and ecosystem development. Bitcoin's narrative is well established, isn't it? As a hedge against inflation or a digital store of value, a sound money principle. However, Ethereum, with its robust smart contract capabilities and its vast, ever-expanding ecosystem of decentralized applications, or dApps, it offers a fundamentally different and arguably more expansive value proposition. When capital flows consistently from one to the other, it indicates a growing belief. A belief that Ethereum's powerful network effects, its transparent and predictable upgrade path, and its potential for yielding returns through staking are collectively creating a more compelling and diversified investment case for sophisticated investors. Investors who are seeking long-term growth and utility in the digital asset space. This isn't just a passing trend. It represents a potential recalibration of what investors consider to be the most valuable and strategically positioned assets within the crypto economy.
And this leads us to the corporate pioneers holding ETH. A trend that certainly resonates with Bitcoin's early corporate adoption, but with a distinctly different and perhaps more nuanced flavor this time around. The pioneering trend set by companies like MicroStrategy, placing significant amounts of Bitcoin on their balance sheets. That was seen as audacious, even revolutionary, just a few years ago. Right? It was a bold, highly publicized move for a public company to take on that kind of exposure to a novel, volatile asset, primarily for its perceived store of value properties and as an inflation hedge. Now, we are witnessing a similar, yet perhaps even more strategic, diversification of corporate treasury assets. But this time, the focus is increasingly on Ethereum. This isn't just about putting another digital asset on the books. It's signaling a broader, deeper institutional faith in Ethereum's utility, not just as a speculative asset that might appreciate in price, but as something with clear, demonstrable yield potential and profound long-term value rooted in its programmable nature. Consider the shift in the boardroom. Imagine a corporate treasurer presenting to their board.
We're not just buying a digital asset, we're strategically investing in a sophisticated platform with integral staking potential, a vibrant and rapidly expanding DeFi ecosystem, and a clear, well-defined roadmap for future development and scalability. This shift in language, this move from pure speculation to strategic integration, it's incredibly powerful. It speaks volumes about how perceptions of Ethereum are evolving within traditional corporate finance, signaling a mature understanding of its capabilities beyond simply being digital oil.
Exactly. This isn't simply following the crowd or mimicking past Bitcoin strategies. It's companies making genuinely strategic, forward-looking decisions based on Ethereum's evolving fundamentals and its unique capabilities as a programmable blockchain. It shows an understanding of its potential beyond being just digital gold, and truly embraces its role as a global computer, a decentralized operating system that can power a vast array of applications, financial services, and future Web3 initiatives. When corporations allocate treasury assets, they are typically scrutinizing factors like risk-adjusted returns, liquidity, long-term stability, and strategic alignment. The fact that they are increasingly considering Ethereum suggests they see a future where its utility provides sustained value, potentially even through active participation in its ecosystem for yield, rather than just passive holding. It reflects a deeper analysis of Ethereum as a crucial piece of digital infrastructure, an investment in the future of decentralized technology, not just a currency.
What's also incredibly important to factor into this analysis, which gives these current trends a strong historical underpinning, is past precedent. ETH's recapture via upgrades. This isn't just about what's happening now. It's about a long-term, meticulously executed strategy that's consistently delivering. JPMorgan itself previously noted, and they've been tracking this for a while, that significant upgrades such as proto-dank sharding could fundamentally help Ethereum reclaim crypto market share. Let's demystify proto-dank sharding a bit, as it's a critical technical concept. It's a technical term for a major improvement to Ethereum's network that focuses on making it vastly more scalable and efficient. Specifically, it introduces a mechanism called data blobs, or proto-shards, which allows the network to process much larger amounts of data more cheaply and efficiently without increasing the computational load on the main chain. Think of it like adding extra lanes to a superhighway and creating express delivery trucks specifically for data, significantly reducing congestion and, crucially, lowering transaction costs, gas fees for users. These structural upgrades, which improve scalability, efficiency, and reduce transaction costs, they're like upgrading the very engine of a high-performance car while it's still running, making the platform faster, more robust, significantly more user-friendly, and ultimately more valuable for everyone building on it and using it. These continuous technological advancements aren't just theoretical. They actively amplify the current positive fundamentals we're discussing. It's not just about current market activity driven by sentiment, but about a long-term roadmap that's consistently delivering on its promises, improving the core product itself. The network is becoming more capable, more resilient, and therefore intrinsically more attractive to both users, developers, and institutions.
Exactly. Consider the profound compounding effect of these upgrades. Improved technology like proto-dank sharding leads directly to greater utility, making the network inherently more appealing for developers to build innovative applications, and for users to engage with those applications without prohibitive costs or delays. Greater utility and adoption then attract even more users and developers to build on the platform, which, in turn, generates more transaction fees, solidifies network security through increased staking, and expands the entire ecosystem. This vibrant, growing, and increasingly efficient ecosystem then inevitably attracts more institutional interest. As they observe a platform with tangible real-world applications, verifiable adoption, and a clear trajectory for future growth. It's a powerful, self-reinforcing, virtuous cycle. This historical context from JPMorgan reinforces the idea that Ethereum's outperformance isn't accidental or solely market-driven. It's a direct result of deliberate, fundamental improvements to its underlying technology that are now coming to fruition and driving genuine adoption and sophisticated investment.
And finally, let's talk about regulatory confidence growth, which for any institution considering significant capital allocation is undeniably a massive foundational factor. The evolving SEC clarity, specifically around the classification of liquid staking tokens, and now the innovative ETF mechanics like in-kind redemptions. It means institutions are now significantly more comfortable entering Ethereum-based strategies. For a long time, the pervasive shadow of regulatory uncertainty cast a pall over much of the crypto market, effectively deterring large, compliance-focused entities like pension funds, endowments, and major asset managers. This comfort moves well beyond pure speculation. It empowers institutions to engage with Ethereum as a legitimate, regulated, and understandable asset class within their diverse portfolios. The impact of this on risk assessment cannot be overstated. When regulatory uncertainty diminishes, the perceived legal and operational risk for large regulated entities also decreases dramatically.
This clearer path paves the way for much more significant and sustained capital allocation from these institutions. They were moving from tentative exploration to strategic long-term investments because they can now plan with a much greater degree of certainty, which, as we all know, is an invaluable commodity in the financial world. It's the difference between navigating a dense fog and sailing on a clear, well-charted course.
This regulatory shift is, without a doubt, one of the most significant undercurrents influencing the market dynamics we're observing. Institutions operate under incredibly strict guidelines, facing intense scrutiny from both regulators and their own shareholders alike. The perception of legal and operational risk is absolutely paramount for them. When they perceive a clearer path, a substantial reduction in legal exposure regarding issues like staking classification or ETF operational mechanisms, it effectively opens the floodgates for more sophisticated and substantial engagement. This isn't just about getting approved for an ETF, it's about building long-term trust in the asset class, validating its place within the broader financial ecosystem, and allowing a much broader swath of the financial industry to participate without fear of punitive action or unforeseen legal repercussions. This long-term trust building is far more impactful than any short-term price movement, as it lays the groundwork for sustained, foundational, and truly institutional growth.
Numbers and trends can sometimes feel quite abstract, can't they? Especially when we're just talking about them. But when you visualize them, the story truly comes alive, becoming almost undeniable. So let's walk through some of the key metrics JPMorgan is looking at and what they tell us. Even if we can't see the actual charts right now, let's try to paint a mental picture together. First, imagine a chart showing two distinct lines. One line represents ETF inflows, which you would clearly see consistently rising through July and continuing that steady upward trend into August, a continuous stream of capital entering. The other line would be for BTC ETF inflows. You'd see that peaking sharply in July with a surge of initial excitement, but then showing a clear, slight decline or at least leveling off as August progresses. The significance here, even just picturing it, is how strikingly and undeniably it visually demonstrates the stark divergence in capital allocation and investor preference. The divergence that JPMorgan has highlighted. It's not just a subtle difference. It's a very clear image of two different trajectories for these two monumental assets.
Absolutely. And then if we were to look at an overlay of Ethereum's price trend alongside Bitcoin's price, you'd visually encounter something truly compelling and, I would argue, almost causal. It would specifically highlight how ETH's performance demonstrably shifts and strengthens during those periods of high ETF inflows. You'd see a clear visual correlation, a synchronous movement where, as the capital consistently flows into Ethereum ETFs, Ethereum's price reacts positively and notably. This directly and tangibly shows a market reaction to the inflow data, suggesting that the capital isn't just sitting there idly, it is indeed actively impacting performance and validating the market's immediate and sustained response to this fresh demand.
Okay, for corporate holdings, let's try to envision a clear pie chart, or maybe a vivid bar graph representing Ethereum's total circulating supply. Within that pie, you'd see a distinct growing slice, perhaps highlighted vividly in a different color, representing the significant percentage, that 2.3% we mentioned, now securely held by publicly traded companies. For additional context, you might even have a smaller bar placed next to it, illustrating corporate Bitcoin holdings, allowing you to see the relative scale and the emerging trend. The significance of this visualization is how it powerfully illustrates the increasing institutional stake in Ethereum and its growing adoption beyond individual investors and even beyond the initial wave of corporate Bitcoin adoption. It paints a robust picture of serious, diversified commitment from the highest echelons of traditional finance.
Continuing that, think of a simple, incredibly easy to understand comparison table, one that clearly contrasts the expected financial returns. On one side, you'd have the potential attractive returns from staking-enabled ETH ETFs, poised to offer a compelling yield, a consistent income stream. On the other, you'd see the traditional BTC ETF structure, which, by its very nature and design, typically does not offer any native yield or income. This striking visual comparison would immediately and unambiguously highlight the potential profitability advantage of gaining ETH exposure through these new yield-generating ETF structures, making it incredibly clear why an income-focused investor, or indeed a corporate treasurer, would find Ethereum an increasingly appealing and competitive proposition. It's a fundamental differentiator that the market is rapidly beginning to recognize and price in.
And finally, imagine a clear, concise flow diagram that simplifies the often complex world of ETF redemptions. One path would show traditional cash redemptions, vividly illustrating the step-by-step process. The ETF has to actively sell crypto on the open market, then convert that crypto into cash, and finally gives that cash to the investor. This path, you would see, often leads to market pressure, especially during downturns. The other path, clearly distinct and highlighted, would show in-kind crypto redemptions. Here, the ETS gives the actual crypto directly to the investor, entirely bypassing the need for a market sale. This visually emphasizes a much smoother, significantly more liquid process that effectively avoids those disruptive forced sell-offs. The significance here is how clearly this clarifies that these innovative ETS structures are profoundly enhancing market stability and overall efficiency for Ethereum, making it truly more resilient and institutionally attractive asset.
When we interpret all these metrics and visualizations together as a cohesive narrative, it paints a truly compelling and, I would argue, undeniable picture that extends far beyond mere short-term speculation. We're witnessing not just a shift in capital allocation, but also profound structural improvements and continuous innovations. Innovations that are collectively making Ethereum a more attractive, a more resilient, and critically, a more institutionally palatable asset. This powerful convergence of financial mechanisms and technological advancements strongly suggests a deeper, more enduring transformation in its market position.
So what does this all mean for you, our listener, and for the broader crypto market at large? It's a profound convergence of incredibly powerful factors, increasing capital flows from discerning institutional investors, crucial and growing regulatory clarity that significantly reduces uncertainty, a growing corporate belief in its multifaceted utility and attractive yield potential, and continuous technological advancements improving its core infrastructure and capabilities. All of these elements are consistently pointing towards a potentially stronger, more dominant, and more integrated position for Ethereum in the rapidly evolving crypto market, fundamentally challenging the long-held supremacy of Bitcoin. It's an undeniably exciting and dynamic time to be watching this space unfold, witnessing a potential reordering right before our eyes. This deep dive has truly uncovered some powerful drivers behind Ethereum's recent strength and its demonstrated outperformance over Bitcoin. But what do you think? We genuinely love to hear your insights and perspectives on these major shifts. We're all trying to make sense of this rapidly evolving landscape together.
Do you see staking-enabled ETH ETFs as a true fundamental game changer for the entire crypto market, fundamentally altering how investors approach digital assets and making crypto a mainstream income-generating asset? Or do you lean towards believing it's just another fleeting trend, a temporary craze that will eventually fade as market dynamics shift?
And from a purely investment perspective, if you were reevaluating your portfolio right now, would you prefer to get your crypto exposure via these potentially yield-generating ETH ETFs, capitalizing on that income potential? Or would you stick with what has historically been considered the more traditional, straightforward BTC holdings, valuing its pure scarcity? This truly raises an important question about your personal risk tolerance, your investment goals, and what you prioritize in a digital asset portfolio.
Could more corporate ETH holdings genuinely push Ethereum ahead long-term, establishing it as a primary institutional asset class that could rival or even surpass Bitcoin's corporate adoption? Or do you believe this is primarily short-term momentum fueled by market hype that, despite its current strength, could dissipate?
And those in-kind redemptions, while we've explored their benefits, do they truly solve the core liquidity issues for ETFs, making the market significantly more robust and less prone to volatility? Or are we perhaps glossing over deeper, more complex structural problems within the broader crypto ecosystem that still need to be addressed before true stability is achieved? This encourages us to think critically beyond the surface-level benefits.
Ultimately, as you reflect on everything we've discussed, which single factor do you think matters most for Ethereum's future dominance? Is it the irresistible promise of staking and yield, the increasing and crucial regulatory clarity, or the growing corporate backing and their active participation in the ecosystem's utility? We're truly curious to know what stands out most to you.
Given JPMorgan's consistent attention to Ethereum's structural upgrades and evolving market dynamics, it prompts us to consider a truly fundamental question for the entire digital asset space. Are we witnessing the start of a deep structural recalibration of the crypto market hierarchy, where utility, programmability, and yield begin to fundamentally challenge pure digital scarcity as the primary value driver? Or is this simply a cyclical rotation that will eventually see Bitcoin reclaim its full dominance as the undisputed market leader? And perhaps most importantly, what does this ongoing competition and profound evolution between these two giants mean for the entire Web3 world, for developers, for innovation, for the future of decentralized technology, and for how we all interact with the digital asset?
We've taken a truly comprehensive deep dive today into JPMorgan's 4 key drivers behind Ethereum's recent and sustained outperformance. The massive ETH ETF inflows, the profound anticipation of staking for ETH ETFs, the undeniable growing corporate adoption of Ethereum, and the crucial regulatory clarity coupled with innovative ETF structures like in-kind redemptions.
It's clear these interconnected factors are collectively creating a powerful, long-term tailwind for Ethereum, driving significant institutional interest and capital into its ecosystem.
These aren't isolated events, they're interconnected threads weaving a powerful and compelling narrative. A narrative of increasing institutional acceptance and fundamental strength for Ethereum. The discernible shift in capital flow, the significant allure of yield through staking, the undeniable corporate validation, and the improved market mechanics. They all collectively contribute to a robust and increasingly persuasive case for its future trajectory and potential prominence in the digital asset space.
If this breakdown on Ethereum's ascent over Bitcoin is helping you make smarter portfolio moves, or just better understand the crypto landscape, please take a moment to like this deep dive, subscribe to our channel, and hit that notification bell. Your support, your comments, and your engagement really help us out. It boosts our visibility in the algorithm, helps us reach more curious minds like yours, and ensures we can keep creating this kind of quality crypto content for you, keeping you ahead in the fast-moving Web3 world. We truly appreciate every single one of you.